All right, let's go ahead and begin. Okay, welcome. Today is Wednesday, August 10th, 2022. It is just afternoon in New York City. Glad you're here with us. So much for that lotto yesterday. Yesterday I put up a lotto play on SPY, thinking that if inflation numbers come out, it's above 8 or so. Consensus was 8.7. The consensus for the inflation CPI was going to be 8.7. It came out at 8.5. Market rallies. I mean, that's just my luck, right? Whenever I buy puts, the market wants to rally. Every time I buy calls, the market wants to dump. Murphy's Law, right? We saw a little bit of a positive reaction. Also, too, this morning I noticed that. And this is something that I've noticed actually in the last couple of days, but especially today, right out the gate, as the markets opened, we saw huge amounts of call buying, small orders, huge amounts of call buying, which suggests to me that retail is getting involved. And also, too, I don't know if you guys noticed, but TradingView this morning was acting really slow. It was really glitchy this morning, and the reason why, I have my own beliefs on why TradingView has its glitches, but generally when TradingView is lagging like that, it usually means that retail traders are all on their trading platforms or on their charting platforms trying to chart the market. Okay, so I use that kind of as an indicator. If I notice that TradingView is acting really glitchy and really slow in pre-market, that's an indicator that retail is getting involved. And then sure enough, right as the market opened, call buying, tech names, I mean, you name it, all the stuff that retail loves to do. Retail loves AMC. Retail loves these kinds of names. Let's actually take a look. AMC, it did pop up this morning. All right, it popped up, lots of call buying, and then it's already getting faded. All right, same thing with what's another one? Bed Bath and Beyond. This is the one that had the CEO got kicked out because of bad earnings, and it caused a rally, and then it caused all the other meme stocks to go up too. So this one also popped up. Also, with all this call buying in the morning, getting faded. Generally, retail loves to get involved in the opening bell, okay? Pros and institutions, they wait till the closing auction. Retail loves opening bell, and in about an hour or so, their momentum goes away. What else is a meme stock? Oh, GameStop. All right. GameStop also... call buying, getting faded. Okay, so all these names are getting faded. If you actually look at SPY and QQQ as well, a lot of call buying, net call buying today on SPY and on QQQ. All right, Tesla, same thing, very sentiment driven. Lots of calls being bought on Tesla. Generally, when retail starts buying all these calls in the market, that's not a good sign. Generally, that means that we're very close. To like some sort of topping signal. All right, we'll see if that happens again. It doesn't have to happen. I'm not trying to predict the future. I'm just anticipating what could be. And so right now, that's just what I see. I see call buying. All right, we're already seeing some parts of the market already fading this move. If we actually take a look at one of our indicators, which is the 5-year Treasury bond, we're actually noticing, oh, well, look at that. Did it just pop? Huh. This was actually in the red just a couple minutes ago. Let's take a look. Huh, okay. So... no, it's not. Okay, so yeah, so you see it is getting faded for the 5-year note. We had a big response. It's already starting to fade. TLT, I think it's the same thing. We're starting to see a fade. Oops. Okay, TLT is actually in the negative already. All right, maybe it's anticipating weak auction performance in about an hour when the auction happens. We'll see. We'll see. That auction is going to be the tell. Generally, we see a lot of volatility that happens around that auction. Not the last one, because the last one was actually a pretty strong bid in the auction, but the one before that, we actually saw some volatility around that. Already TLT reversed its moves after the CPI report. Okay, ZEF is already working on reversing as well, which is our 5-year. And again, that's one of our indicators. When ZF is going up, all right, in this market right now, if ZF goes up, that is a cash is trash indicator. So if ZF is going up, okay, that means the shorter term yields are coming down. That steepens the yield curve, and the carry trade, the benefits of holding on to the US dollar becomes less. So it becomes cash is trash. So they have to look for a risk asset to buy into. Okay, so that's a risk on indicator. If ZF goes down, that is dash for cash. So that just means, screw risk assets. I'm buying the dollar and keeping money in the dollar. Okay, that's what it means if ZF keeps going down. All right, so keep an eye on this. Keep an eye on what happens in the auction. I do think that if this reverses and actually goes into the red, that is going to be a sign that we're going to see more fading in this market. Equities can act in this way where it pops up for like a day or two and then fades a couple days later. Okay, it doesn't have to fade like immediately in the same day. All right, bonds are already starting to start fading same day. All right, but equities may follow a little bit later. Okay, it doesn't have to happen today, guys. So if you don't see that reversal today, don't think that bear market is over, full on bull. No, not necessarily. Okay, so right now, that's how retail is positioned. Retail is right now thinking that this is the bottom and that's it, and they're just buying calls right now. Will they be right? We'll see. All right. Generally, they're not right. I'm actually curious on what the 10-year is doing right now. 10-year also getting faded. So a lot of these moves are getting faded in the bond market after the initial hours here. Let's just take a look. I just want to see what this looks like. Yeah, it's starting to get faded. Okay, well, we will see. We'll see if this continues or not. All right, so that's that. Let's take a look at what's going on abroad market. We'll take a look at the indices as well. But the dollar is dropping. It dropped a lot after this report. Literally fell off a cliff. It's down. The dollar index is down 1.3%. For you guys, 1.3% may not seem like much, especially for those of us that trade smaller equities. But for currencies, and especially the currency, the dollar, 1.3% move is a huge move. All right. We will see what happens if the dollar keeps dropping. All right. That just means that the floor on the U.S. indices is going to keep going up. All right. If you actually look at, let me pull up our charts of euro denominated. So if you actually look at the S&P 500 priced in euros, we actually came all the way up to near all-time highs. All right. And if the dollar keeps dropping, that just means that the dollar denominated chart is going to have to catch up to the euro denominated chart. Okay. So if the dollar drops more from here, that just means that the floor keeps rising up, and then we might see the dollar going up. If the dollar just completely drops, all right, I don't think that's going to happen, but let's just say it goes past our green line here and just keeps going down. First of all, I think that would be terrible for the Fed. Fed credibility would just go out the window. All right. Nobody would take the Fed seriously if that happened. All right. Definitely the Fed has an incentive to try to talk that dollar up. All right. But let's just say okay? If the dollar drops and keeps dropping like that, then we're going to the moon. All right, we're going back to all-time highs on the S&P 500 and on the Nasdaq. All right, Nasdaq priced in euros hasn't really recovered as much, but if the dollar drops, very likely that we go see around that 15,000 zone if the dollar drops. Okay, I'm not saying it's going to drop, but I'm just anticipating what could be if that happens. All right. Same thing with the S&P 500. If the S&P, if the dollar drops, I suspect that the S&P 500 will probably then go to like 4,600 zone. All right. I don't know. I think that's a very low probability, but it definitely is possible, okay? And that is why I've kept all my put positions very small in the market. However, I did add some more to my QQQ puts, all right? My QQQ puts are for November, the 305-295 put vertical spread. I'll go over all that at the very end too, but I did add a little bit more to that. And right now I am about 8% invested, 92% cash. So this is probably the most of my speculative account that I've utilized now since June. Okay, so since June, this is the most cash that I've utilized in the spec account, 8%. All right, so I've been keeping positions really, really small. And now that we're at these like edges of our price structure, I am starting to add more to it. All right. I do think it reverts. I think it gets faded. All right. I do think this gets faded. I do think, though, it may take a couple of days, especially with the dollar coming down like this. All right. Some of the other things that I wanted to share with you guys, and some of this stuff is not really on the charts. You know, it's more of data and some of the things that some of the banks are reporting. But I believe Jamie Dimon, or one of the big bank CEOs, had an interview, and they were actually saying that the business and consumer markets were actually quite resilient. One of the charts that I saw, and I'm trying to find it online, but when I heard that interview, they mentioned that the bank CEO mentioned that corporate debt, all right, and those interest payments that businesses pay as a percentage of revenue is at multi-decade lows, all right. So we've actually seen revenues beat to the upside this quarter, which was very unexpected. Most people were expecting earnings to go down, but actually earnings went up, and so the amount of interest expense as a percentage of that revenue is actually down. And so that's an interesting problem for the Fed, because the Fed is trying to tighten, but at the same time, businesses and consumers are actually very strong. I think it gives them the case to tighten more. All right. I think the market is still actually pricing in a rate cut in 2023 around June and July. It is still pricing in one rate cut, which I think is kind of crazy. All right. My own opinion is that that's craziness, but it's not about my opinion is not important. The story that I tell myself in my own head is not important. And what's more important is what is the market doing, and that's what the market is pricing in. They're pricing in one rate cut. All right. I think definitely, if especially with this Jackson Hole symposium coming up, if they start expressing a more hawkish tone because of all this exuberance, and especially also too, I know the Fed is looking at some of these meme stocks. The reason why you guys know how I feel about meme stocks, all right? The reason why I'm even going over those kinds of meme stocks is because I'm pretty sure the Fed is looking at that too, taking a look at market risk appetite, all right? And right now, the market, it basically, is basically saying that that they can handle more tightening. And I think, in my own opinion, I think the Fed should tighten a little bit more. That's just me, though. I'm not in the Fed, so it doesn't matter what I think. But definitely, risk taking is increasing, and we're actually seeing it also in the junk bond market as well too. Junk bond bids. I mean, there's bids going on right now in the junk bond market. If you look at our Discord and look at our advanced decline line, our advanced decline line on the junk market has just been going up, 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 and up. All right. It looks like junk bonds are also getting the initial fade as well too after that CPI report. We shall see, but definitely if we get to this level right here around the 80s in HYG, I think the Fed would take notice of that and would want to talk the market down. All right. If you look at our spread, all right, which is the junk bond spread, let me actually update this and see if any new data points came about. If you look at this right now, it's actually making higher lows. Okay, if this chart is going up, it means that the perceived risk in corporate bonds is a lot higher to the 10 in relation to the 10-year Treasury. All right, so generally, this going up is a risk-off sentiment. This going down is risk-on. All right, it's still on an upward trend. All right, so the corporate bond market is still showing that there is still a risk premium being priced into the junk bond market. It's just still, however, we're staying risk-taking. We're still seeing companies, zombie companies, able to get cheap credit, okay, as a percentage of revenue. So yes, even though it is not as cheap as what it was a year ago, because revenues are going up, as a percentage of that revenue, they're actually spending less. So again, it just shows you the kind of challenges the Fed has. I'm not trying to sympathize with them. They created this mess. They could have acted a little bit sooner, but they didn't. And now they have to clean up this mess. So we shall see how they take it. I do think, though, that the base case for more tightening is starting to get set up. Let's see what the market priced in afterwards. I refreshed that right before. Oh, look at that. Wow. Wow. Did you see that, guys? So I purposely didn't refresh this site. You saw that, right? It was 68% on the 75 basis point hike, right? You just saw that, and I just refreshed it. That was taken right before the CPI report. So right after the CPI report, it just flips. So now the market is pricing in a more dovish Fed, and only a 50-point rate hike. Just because it goes from 9.1 to 8.5, I don't know. That I think the bond market is getting a little bit too ahead of itself. But again, that's just my opinion. We have to go by what the market is telling us to do. So that's interesting. Wow. So now we're at 62% for a 50 basis point hike. No more 75. Huh. The bond market is being very fickle. It's like it's almost like the Fed funds rate is like a meme stock market. It's just so quick. Usually those kind of moves took like weeks. Now it takes hours. Now it's taking the same day session. That's crazy. So 50 basis point hike this round. Next month, in November, also they're pricing in a possibility of a 50 basis point hike in November. In December, let's see. Either we maintain whatever we did after November, or possibly even up to one rate hike of 25 basis points. So then in February, again, the possibility of us going to 375. And do we still have that rate cut possibility? Yes, we do. It got moved up to between May and June. So the market is pricing in an even more dovish Fed. So now they're pricing in even more dovishness. So this sets up for a disappointment if the Fed gets hawkish. Will the Fed get hawkish? Okay, trying to gamble on what the Fed is going to do is a fool's game. Okay, there's no way. There's no way you and I can manage risk effectively and try to bet on what the Fed is going to do. All right? There's no way. But the market is pricing in a much more dovish Fed, which sets us up for a disappointment if the Fed gets more hawkish, and I think they do. I think they will get a little bit more hawkish. They will have to have a more hawkish tone, especially if the dollar keeps dropping. The dollar keeps dropping like this and the market keeps going up, the Fed will lose credibility, because all of that jazz, all of that stuff that they did in the past month or in the past 5 or 6 months, it all gets negated. It all gets negated if this all drops and the market just keeps going up. Okay, if the dollar drops and equities just keep going up, it reverses everything they've done in the past 5-6 months, and then the Fed really becomes a joke. All right, I don't think that's what I don't think that's the legacy that Jerome Powell wants to have. All right, but we'll see. We'll see what happens. Again, I'm still relatively mostly in cash. Although I'm 8% now invested, I do think that. I still think that we still see one big sell-off. But if the dollar keeps dropping, that sell-off is going to be a little bit more shallow than what I anticipated in the equity markets. Okay, but we'll see. We'll see. All right. Next, be on the lookout for that bond auction. It happens in about 40 minutes. Tomorrow is the 30-year auction. Okay, if we see weak demand in both those auctions, expect TNX to go up. Expect interest rates to go up. If interest rates start going up, I think that will put some headwind, some downward pressure on the stock market. And I'm sure the Fed will welcome that. They probably want to see that. And I think they're holding out. Oh, look at that. Look at that. HYG coming more down. All right. Will we see an evening star in HYG? That would definitely get things very spicy in the equities market. Okay, we'll see. Let's take a look at some of our other data. Let's look at TIP over TLT. It gapped up and it's moving up. Inflation expectations going up. Interesting. It's still that's just one day. It's just one day's movement, so I shouldn't say it's going up, but it's still in that no man's land. It's still in the bottom of the range. We are not seeing it drop though, okay, which is interesting. We're not seeing it drop, especially after that kind of equity response and better than expected CPI report. I would have thought this would have gone down a little bit, but it's not. Interesting. All right. Volatility on the bond market is still elevated. As long as this is going up, I do think that institutions will be a little bit more hesitant to enter the market. I think a lot of this market going up is call chasing by retail. All right. It's the same thing that we saw in end of 2017. It's the same thing that we saw at and the beginning of 2018, and also what we saw at the end of 2021. Okay, lots of just call buying. All right, it was not from institutions; it was from retail. All right, we'll see if that continues. What else? Oh, this, which is our 10-year indicator for our 10-year yield. It is curling up a little bit. However, the 10-year is still a little bit disconnected from this. This is our copper to gold ratio times 1,000. It's just been a good indicator of where the 10-year will go within the coming weeks and months. It's been surprisingly good indicator. Although there has been mismatches, but whenever there is a mismatch, they do tend to merge at some point. Okay, so I do. That's why I still have that plan to buy Treasury bonds when it gets to, or the TLT when it gets to 112 or so, the 112, 113 zone. I do have that in my plan to buy and go long in TLT at that point. All right, so we'll see if that happens. Oops, wrong chart. Let's go back to this one. This is the 30 and 10-year spread on the treasuries. It is going up. Okay, it is going up. What does that mean? It just means that, that we're pausing on this slowing down of growth story in the market. Okay, whenever this goes up, generally it just means that the market is expecting the economy to improve. This one day doesn't really tell me much. I need to see that continue and go up above that 0.4. Okay, if that is not going to go up above 0.4, then forget it. All right, this is just noise. All right, we are seeing bank stocks seeing a little bit of a rally today because of this. Look at that, the 10 and 2 year. Okay, generally when we see this go up, we see a relief rally in bank stocks. However, I do think this is temporary. It could just go up and then curl back down. However, the 10 and 2 year, this is pretty low. It hasn't been this low since the early 90s, late 80s, early 90s. So that's really low. Will we see a little bit of a bounce like here? Possible. Okay. So we could see a little bit of a relief rally in XLF. Okay. So keep that in mind.